Well, it's just hard to earn your net interest margins if you have such a flat yield curve. And at the same time, they are doing better. They're better structured. They're more liquid. They have better capital bases. And if you think that's bad here, look at the European banks. I mean, it's even worse in terms of what's happened to that index over time. It's had a little pop back up, but it's been hammered over the last year. So these low interest rates, in their case negative interest rates, do enormous damage to the potential for the banking system. And I think that's pretty clear in the way the markets reacted.
Richard, the markets are cheering what the Fed has done. I'm wondering if you are, if this is ultimately the right move. There was that argument that the Fed needs to hike in order to have the so-called dry powder in case something happens. Are we going to be in a position that the BOJ finds itself in right now, that the ECB finds itself in right now, down the road?
Well, I think that's a risk. I'm a Texan, so I like to talk about nuts and guns. And you know, there aren't too many nuts in the tree, and we don't have much ammunition in the Fed holster right now. The balance sheet stuff, by the way, doesn't surprise me at all. If you look at currency in circulation, you added that an expectation for bank reserves under the new regulatory regime and other things that have to be on that side of the balance sheet, you really cannot get the balance sheet much lower than what they've already said they will do by September. So the interest rate side, in terms of storing nuts in the tree, is a good squirrel would do for when the winter comes. There's not a whole lot to deal with going forward, and I think that is the difficult decision the Fed has to deal with here. The short term, wait and see what the data says, wait and see what comes out of all the reports on the economy, anecdotal as well as data. And at the same time, how do you prepare for the future when the economy weakens?
Yeah.
If you look at the statement, they were talking about there still is strong full employment, there still is a good tone of the economy, but they want to watch and see. And I don't disagree with Jamie Dimon from the standpoint this is a good time to do so.
We've had nuts and luncheon meat. We've had it all here today on Power Lunch. Richard, does it get any more transparent than this in terms of Fed policy and statements?
Yes, it can get too transparent. I like the fact the statement is so bloody short right now. It was 950 words we got it up to when I was at the Fed, and we had, of course, long explanations at the press conferences. It depends. Ben Bernanke was a believer in efficient markets. I don't think Jay Powell is a great believer in efficient markets, but the more information you can get out there, the better the chances are the market discounts things more realistically than just being based on rumor and false expectations.
This sounds to me like
very importantly what they want to hear.
What used to be called the full hangout route, right? I mean, there's not much left here to the imagination.
No, and I'm a little concerned. Again, I would have cautioned them if I were still sitting at the table. You know, to commit to not doing anything for the rest of the year, that's 9 months, that's a pretty radical statement. And I'm not sure that was a wise thing to do, but I agree with, again, with our friend from JP Morgan, that this is a time for them just to study carefully. They're responsible people, they're good people, they're earnest people, and they're just trying to get this right. I might have disagreed with making that statement, but I don't disagree with the non-action that was taken here.